Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife Podcast. I am your host, Dan Sipe. Additionally, as you already know, I'm the branch manager here at Sipe and Associates and Serving Those Who Serve. I want to begin, as I always do, by saying thank you. Thank you for your service. Thank you for taking time to listen. You do not hear it enough. You'll always hear it from me, and you'll always hear it here. The other thing that you always hear with us is the guru, Ed Zurndorfer. He is back with us yet again as part of our ongoing mission to reach, teach, and serve you. Now, at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. And this podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. If you do not have an advisor, hit us up at Serving Those Who Serve. We will help you any way we can. Once again, we will follow Ed's FedZone articles. And today we have a topic that a lot of feds may not think about, but you probably should. And that's the impact of how the Secure Act, which was passed a while back, impacts when we might inherit IRAs from our loved ones. And we'll actually have two podcasts on this. So, Ed, let's start with some background, because I think the people who might be familiar with inheriting IRAs are probably more familiar with the old system where, you know, somebody passed away, left you an IRA, say it was your folks or something like that, and you pretty much got to take that out of your whole life. That's not the way it works anymore, correct? So give us a high-level view on that Secure Act.
Yes, Dan. The Secure Act was passed in December 2019. It took effect on January 1st, 2020. Among the major provisions in the Secure Act is that it allows only a certain class of individual beneficiaries called eligible designated beneficiaries. Those are people who inherit traditional IRAs and company retirement plans, and that would include the Thrift Savings Plan, to stretch out post-death required minimum distributions over their life expectancies. If I can just back up here for a moment, because before the passage of the Secure Act, if someone like a child or a grandchild inherited, let's say, their parents' or grandparents' traditional IRA, they had to withdraw the money, but they could withdraw their money over their life expectancy. Now, let's think about this. Suppose you had an 18-year-old grandchild who inherited a $200,000 traditional IRA from grandpa. An 18-year-old has a life expectancy, let's say, of about, probably about 75 to 80 years. They would only have to take out 1/75th of the IRA balance in the first year, and then 1/74th the next year. In other words, they take out a little amount each year. They would get basically a lifetime income from this IRA. They'd have to pay tax, but not that much tax, because they're not taking out that much. But under the Secure Act, anyone who passed away after December 31st, 2019, who designated someone other than an eligible designated beneficiary, that beneficiary had a 10-year payment rule, so meaning they had to withdraw all the money in the traditional IRA within 10 years of their inheriting the IRA. They did not have a lifetime payout. They had to take it out all within 10 years. Now, I have to tell you, Dan, that initially when the Secure Act came out, there was not a lot of guidance about that in terms of, did they have to take out a certain amount each year, within the 10-year period, or could they wait until the end of the 10th year to take out everything? There was no guidance. Well, IRS came out this past February with the final rules regarding this 10-year rule. We'll get into more of the details here in a few moments. But again, the law has changed now for individuals who inherit traditional IRAs and company retirement plans as a result of the Secure Act. And we'll get into the specific details as we go along here.
Okay. All right. So you dropped an interesting term in there, and I'd like to touch on that one. You said eligible designated beneficiaries. So they're going to have a little different treatment than the 10-year rule, correct?
That is correct. And if I may, I will just at this point tell you who is considered to be an eligible designated beneficiary.
Yes. Tell us what goes into being an EDB.
EDB, so to speak. EDB.
EDB. Yep.
First is a surviving spouse of an IRA owner, or a traditional IRA owner, or a retirement plan participant. Number two, a minor child, someone younger than age 18. Okay. Interesting. The IRS, they updated what a minor child is. It used to be that it had to be according to the state law who's considered to be a minor child, because most states now recognize 18-year-olds as adults, but there were a handful of states that said no, 21. Now it's 18. It's 18. A disabled individual, chronically ill individual, and also an individual who is not more than 10 years younger than the IRA owner, traditional IRA owner, or the retirement plan account holder. Example, suppose someone named a sister or brother who was, let's say, 4 years younger than them or older as a beneficiary of their inherited IRA. That sibling would also be considered to be an eligible designated beneficiary. So that is the class of so-called EDBs who are still allowed to stretch out their inherited IRA or retirement plan inherited assets over their life expectancy.
Okay. So I'm not being a cynic here, Ed, but I've been at this in a while, so I've kind of learned the devil's in the details. So when I hear something like disabled or chronically ill, but specifically disabled, I'm guessing there's some definitions associated with that have to be satisfied?
Yes. The IRS came out with some more specifics about who's considered to be disabled. And if I could just mention that they came out as in these regulations past February, and you really got to get into the real details here to understand what's going on. Basically, someone who's considered to be disabled would follow the definition of someone who would qualify for Social Security disability.
Gotcha.
People think that they're entitled to Social Security disability because they've been paying the payroll tax for X number of years, and therefore they're entitled to Social Security disability benefits. Well, you have to qualify for that. And Social Security does have a very rigid definition of what disability is. That
Very
being
true.
said, if someone can qualify for Social Security disability, they definitely will qualify for as a eligible designated beneficiary.
No, so getting back to what I was saying, the devil's in the details. So people really need some pretty good guidance on this to make sure that they qualify. Because I'm guessing if you think you are one and you aren't one, there's a problem. Would that be correct?
That's correct. And the IRS actually confirmed this. They said that the definition of a disability means that you qualify under tax code section 72M7. An accountant would definitely know what that is. And if someone is unsure whether they would qualify under the disability definition, they should talk to their tax advisor to find out if they would qualify under this Internal Revenue Code section.
Got it. Okay, so pressing on, obviously the single biggest change under Secure is that for a whole lot of people, they're going to have to get it out in 10 years. And you mentioned that in some cases that would mean wait until the 10th year and take it all out. But some beneficiaries will have the 10-year rule, plus they'll have to take withdrawals in year 1 through 9. Is that correct?
Yes, Dan, and I got to tell you, this was a shocker. When the IRS came out
like
this past in February saying that I know I talked to several tax accountants because I have as you know, I've been in tax practice myself.
Sure.
And no one expected IRS to say, okay, you have the 10 years to take the money out, but no one expected IRS to say, well, during years 1 through 9, you got to take out so-called required minimum distributions each of those years. They thought you could just take out the whole thing at the end of year 10 and satisfy the Secure Act. Well, right. Granted that if you're talking about a huge traditional IRA or a huge retirement account, it's really probably not a good idea to wait to the end of the 10th year and take out such a lump sum, and because that could really push you into a higher tax bracket. So it did make sense to take out a little bit in bits and pieces during years 1 through 9 in order to cut down the tax liability when everything comes out. But it's still, if you take out bits and pieces, it's up to you. For example, if you know in a given year that if within years 1 through 9 that you're going to have less income, because maybe you're retired, you inherited, or maybe you decided to stop working for a time. We hear about all these stories now over the last few years. People have quit their jobs to take time off. They know they're going to have less income, but they built up enough wealth during past years. They said, I'm going to take some time off. I inherited this in an IRA from my relative, and I think I'll take out a little bit more this year than I did in past years because I'm going to have less income. This way I'll pay less tax. Well, under the Secure Act, under IRS's updated Secure Act regulations, they said, no, you got to take out a minimum each year. A minimum. No one expected that. Okay.
So, and this was a year after it went into effect that they came back with these rules, correct?
Yeah. And I got news for you, Dan. When IRS updated Secure Act, they said, well, the required minimum distributions it's going to start in the year 2022. The IRS said nothing about for the year 2021. There were individuals out there. I had an email from a client today. She's a tax client, and she inherited an IRA from her father in October 2020.
Okay.
And she said she was not aware of the fact that she had to take out RMDs under the new law. What does she do? I said, well, you should call your custodian to find out from them. I will tell you, though, that starting this year, for sure, you got to take out an RMD, wait for the final IRS regulations. They have to be fine once, because the House of Representatives has approved the updated Secure Act, but it's still being debated in the Senate. And once it passes the Senate, President Biden will sign a law, and that's when everything becomes official.
That's Secure 2.0 that you're talking about?
That's Secure 2.0. That's correct.
Okay, gotcha.
And IRS said nothing about what's going to happen for 2021. It's going to be made retroactive. So she asked me, "What do I do?" I said, "You're going to have to talk to the Schwab people, to the IRA, to your IRA custodian to find out what their compliance department is saying, their tax compliance department, because right now nobody knows what's going to happen for 2021. All I know is that once Secure 2.0 is passed into law, non-eligible designated beneficiaries, like my client, because she's a daughter of her father, she inherited an IRA, will have to take out an RMD for the 2022, 2023, all the way through 2029. And it has to be emptied out by December 31st, 2030. A lot of uncertainty there, Dan. I tell you, a lot of uncertainty.
Yeah. I mean, because, okay, the one thing I do remember about RMD rules is if you don't do what you're supposed to, there are penalties. So does that mean there could be some people floating around from 2020 that could end up retroactively in trouble and have a penalty?
I don't think that's going to happen, because part of Secure Act 2.0 is the fact that they're going to minimize that so-called excess accumulation penalty. That is, if you didn't take out your RMD. Right now it's 50%, okay. By the way, 50.
Yeah.
We're talking about going down to maybe, I think, believe it or not, nothing if it was not the person's fault. They didn't fault.
All right. That at least sounds a little more fair. It's like, hey guys, we got a new rule. Hey guys, we got a new rule on the new rule, and it's looking back at something that was 3 years ago now. Where we know we didn't tell you what you're supposed to do, but in case you didn't guess right, there's a penalty. That seems more fair to me.
I agree. So
Ed, go ahead.
I got to tell you, Dana, that anybody listening to this podcast either now or they're going to be listening to it, I don't care what your age is. You might be in a position where you inherited an IRA, in a traditional IRA or workplace retirement plan from a relative. Please be aware of the new rules that they will take effect, and you just can't ignore it, because this is a big change from what it was.
Oh, sure, and you're right. It was almost it was nearly a perpetuity if a young person inherited it. I mean, they got to just take little withdrawals for so long. And, this is going to, I can see where this is going to raise tax revenue. But it'll be nice to have all the rules finalized so people know exactly what they're supposed to do. Ed, by chance, will you be touching on any of these new rules in any of your webinars that you do with us?
I'm going. As you know, Dan, we have a TSP webinar every month.
Yes, we do. It's one of our core 4.
And once these rules are finalized, that is, the Senate passes Secure Act 2.0, and I guess they're going to have to reconcile any differences with the House, and then it goes to the White House for President Biden's signature. He'll sign it. I'm going to put pen to paper and change and make some modifications to my TSP webinar that we do every month, and you'll hear more about Secure 2.0 and how it's going to affect those people who inherited TSP accounts.
Gotcha.
Big changes.
Because again, folks, remember this. It's pretty much any qualified plan that you might inherit from somebody else.
We're talking about traditional IRAs and the TSP, but there are federal employees who inherit 401k plans, 403b plans, SEP IRAs, simple IRAs. All this applies to all that stuff. It's not just the TSP.
Yep. Yeah, I do know that the Secure Act kind of set some things on its ear, and the fact that they're still finalizing the rules a couple years later. Well, hey, that's keeping guys with tax practices busy, isn't it, Ed?
It keeps me busy in the tax practice. It keeps me busy I write in the Fed Zone, as you know, Dan. I write a column every week in the Fed Zone, and I wrote 3 columns on the Secure Act, 3 columns, and I encourage anybody who wants to know more about the Secure 2.0 to please read those columns. They were written in April and early May. You can go to www.fed-zone.com and read about it. In my columns, I always have examples to make people understand, make the readers, understand it better. It helps to see an example. I like to learn by examples, so I just give examples to help the readers understand better what is going on.
Oh, couldn't agree with you more, Ed. And actually, you just took my plug away, because I was going to say, folks, this is big stuff. To be sure to read Ed's articles in the Fed Zone, because it's literally written in front of me, Ed, because they're always really good examples. And also be sure to come back for our next podcast, because we're going to stay on this topic and continue the subject with Roth IRA rules, where trusts might be involved, things like that. There's a lot to this. And this is the only place you're going to find it. I'm just going to put that out there right now. There's nobody like Ed. There's nobody like Ed writing all this stuff. And Serving Those Who Serve, really, really grateful that he's part of our family, so that somebody can come to our site. It's searchable. They can plug in Secure Act, and boom, Ed's articles are going to come up. The podcasts are going to come up. So be sure to share this with people, folks. We see more and more folks are coming to the site and getting their questions answered, and maybe they'll stay and decide to register for a webinar. That's what this is all about. So be sure to catch the next podcast. Ed, you are the man. That's all I can say. And I want to thank you for what you do for the federal community. Thank you for what you do to help us develop. Ed is coming to one of our trainings at Serving Those Who Serve, and he's going to be talking to us about Medicare and things like that. So he's a treasure for us as much as he is for the whole federal community, Ed. So thank you for that.
My pleasure. It's always a pleasure helping the federal employees and retirees understand their benefits, as well as prepare them for the retirement and to make the most of the retirement benefits.
Well, folks, that is a wrap for this episode. Be sure to catch the next one as well. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. And remember to share it with friends, strangers, neighbors, you name it. They will thank you if you do. Check us out on Twitter and LinkedIn. Do not forget those live webinars pretty much every single week. And we have as many as 7 or 8 that we do each month. We have the core 4. You'll see it on the site. That's a great place to start, and then you can go off into some of the more specific ones. But that is always there. Go to the STWS website at stwserve.com, and you will see the big blue webinar button. Click on it, and it takes you through the whole menu. So the guru will come to you, reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share that page with your friends. They will thank you. Read Ed every week in the Fed Zone, fed-zone.com. And do not miss those examples, because they really do make a difference. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, signing off as I always do, saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.